The stock market is a roller coaster. Thrilling highs and stomach-churning lows are part of the ride. But what if you could find an investment that offered a smoother experience, even in turbulent times? Enter Preferred Bank, or PFBC, a California-based bank that's been quietly building a reputation for stability and growth. While the broader market grapples with inflation, interest rate hikes, and recession fears, PFBC has remained a beacon of consistency, delivering solid returns for its investors. Could this be a sign of a hidden gem, a stock poised to outperform in the years to come? Let's dive in and explore the potential of PFBC. Before we delve into the crystal ball and forecast the future, let's ground ourselves in the present. What is PFBC's current value proposition for investors? As of today, May 25, 2024, PFBC is trading at. While past performance is never a guarantee of future returns, it's worth noting that PFBC has consistently outperformed the broader banking sector in recent years. This outperformance is a testament to the bank's strong fundamentals and its ability to navigate challenging economic conditions. But stock price is just one piece of the puzzle. To truly assess PFBC's value, we need to look beyond the surface and examine its underlying financials. One key metric is the bank's price-to-earnings ratio, or PE ratio, which compares its stock price to its earnings per share. A lower PE ratio can indicate that a stock is undervalued, while a higher PE ratio might suggest overvaluation. Currently, PFBC's PE ratio stands at, which is then the average PE ratio for the banking sector. Another important factor to consider is PFBC's dividend yield. As a preferred stock, PFBC is obligated to pay out a fixed dividend to its shareholders. This dividend payment is a key attraction for income-seeking investors. PFBC's current dividend yield is, which is then the average dividend yield for the S&P 500. This attractive dividend yield, coupled with the bank's strong financial performance, makes PFBC an enticing option for investors seeking a steady stream of income. However, it's crucial to remember that investing is not a one-size-fits-all endeavor. What constitutes a good value for one investor might not be suitable for another. Factors such as risk tolerance, investment timeline, and financial goals all play a role in determining whether an investment is appropriate. It's essential to conduct thorough research, consult with a financial advisor if needed, and carefully consider your own circumstances before making any investment decisions. Interest rates are the puppet masters of the financial world, pulling the strings behind the scenes and influencing everything from mortgage rates to corporate borrowing costs. For banks like PFBC, interest rates are particularly impactful, directly affecting their lending margins and overall profitability. When interest rates rise, as they have been doing recently, banks tend to benefit. This is because they can charge higher interest rates on loans while keeping deposit rates relatively stable, resulting in wider profit margins. PFBC, with its focus on lending to small and medium-sized businesses, is well positioned to capitalize on this rising interest rate environment. These businesses are often more reliant on bank financing than larger corporations and are therefore less sensitive to interest rate fluctuations. As a result, PFBC has been able to increase its lending rates without experiencing a significant decline in loan demand, boosting its net interest income. This positive impact of rising interest rates is reflected in the bank's recent earnings reports, which have shown robust loan growth and expanding profit margins. However, it's crucial to remember that the interest rate environment is constantly evolving. While the Federal Reserve has been aggressively raising interest rates to combat inflation, it's unclear how long this tightening cycle will last. If inflation begins to cool and the Fed signals a pause or reversal in rate hikes, the tailwind that PFBC has enjoyed from rising interest rates could turn into a headwind. This is why it's crucial to monitor not only the current interest rate environment, but also the future direction of monetary policy. Investors should pay close attention to the Federal Reserve's announcements and economic projections for clues about the future path of interest rates. Additionally, keeping an eye on inflation data such as the Consumer Price Index, or CPI, and the Producer Price Index, or PPI, can provide insights into the Fed's likely course of action. By staying informed about these macroeconomic factors, investors can better anticipate how changes in the interest rate environment might impact PFBC's performance. Inflation, the silent thief that erodes the value of our savings, has been a persistent concern in recent years. As prices for goods and services rise, our hard-earned dollars buy less and less, putting a strain on household budgets and corporate bottom lines. While inflation can be detrimental to many sectors of the economy, banks, particularly those with a strong track record of managing risk and generating returns, can often benefit from a high inflation environment. One way banks like PFBC can thrive during periods of high inflation is through their lending activities. As inflation pushes up the prices of goods and services, businesses often require larger loans to finance their operations. This increased demand for credit allows banks to charge higher interest rates on loans, boosting their interest income and overall profitability. Furthermore, inflation can lead to an appreciation in the value of assets, such as real estate, which banks often hold as collateral for loans. This appreciation provides an additional layer of protection for banks, as the value of their collateral increases alongside inflation. However, it's essential to acknowledge that high inflation can also pose challenges for banks. Rapidly rising prices can erode consumer confidence and slow economic growth, potentially leading to an increase in loan defaults. Additionally, central banks often respond to high inflation by raising interest rates, which can increase borrowing costs for banks and potentially dampen loan demand. Therefore, it's crucial for investors to assess how effectively banks are managing these risks and whether their business models are well suited to withstand inflationary pressures. PFBC, with its conservative lending practices, strong underwriting standards, and focus on serving businesses in a relatively stable regional economy, appears well equipped to navigate the challenges and capitalize on the opportunities presented by a high inflation environment. However, it's essential to remain vigilant and monitor the bank's performance closely, paying attention to key metrics such as loan quality, net interest margin, and provision for loan losses. By staying informed and analyzing the bank's financial health, investors can make more informed decisions about whether PFBC remains a compelling investment opportunity in the face of inflation.